Here is our Meet Your Fund Manager segment. For all our viewers out there who are watching and who have invested their money in the Franklin India Equity Fund, or for that matter, even are considering investing in the Franklin India Equity Fund, listen up, because we are just about to meet the fund manager of this fund. As you can see on your screens, the risk factor is moderately high. So perhaps for those people who don't have much of a risk-taking ability, this fund may not be you, but moderately high is where the risk factor is. And do remember, with greater risks come greater returns as well. Now, when we speak of returns, however, in the last 1 year, it has had a tough ride in terms of the CAGR, because that's been in the negative. It's not exactly boded well for, the fund holders, because of the fact that the markets as well have been very, very weak. And hence, you have seen that most funds out there have really not been able to deliver very well. But again, because mutual fund investing and equity investing is all about doing so in the long haul, the 10-year CAGR has come in at 10.76%. Double-digit returns. I suppose it is reasonable from a long-term perspective to expect 10 to 12% CAGR, and that's what Franklin India Equity Fund as well has delivered. So the longer you keep on and hold on to your funds, the better it is. Let's look at some of the top stocks, and just as is the case with any other mutual fund as well, banking is a very important part of this fund, because a massive 8.6% of the fund is invested in an HDFC bank, followed by 7.1% in Infosys and 6.2% in a Bharti Airtel. In ICICI Bank as well, a little over 5% has been invested, and then in an L&T, 3.7%, and then there's a little under 3%, or rather 3.5% invested in Axis Bank, HCL Tech and M&M, and a little under 3% in a Kotak Bank and Grasim. So unsurprisingly, even for the Franklin India Equity Fund, banks is a major chunk. In fact, 23%, almost 23% is invested in banks, followed by 13.3% in software because of Infosys, around 9% in consumer non-durables, telecom has around 7.26%, auto has around 6.5%. But like I said, the lion's chunk has gone to the banking space, and that's pretty interesting to know. That's really been the case with most of the mutual funds as well. Now let's talk to the fund manager of the Franklin India Equity Fund, and that's none other than Anand Radhakrishnan himself, who is the managing director and the chief investment officer of emerging markets in India, specifically of Franklin Templeton. Mr. Radhakrishnan, thank you for joining us on the Money Show. Interesting to note your Franklin India Equity Fund and its constituents. So let's start off first with your investment style and strategy for the fund.
So in Franklin Templeton, by and large, we have followed the so-called growth strategy. We think that the best investment returns can be made in investing businesses that keep compounding over a long period of time. Having said that, this has not desisted us from taking occasional contrarian picks where the investor sentiments are going through negative trend and there are meaningful money-making opportunities. So if you ask me, it's a blended style, but with a skew towards growth and good return companies over a longer period of time. If you want to put a ratio to it, probably it's like 80-20 kind of number.
How is the fund spread across large cap, mid caps and small caps?
Currently, Franklin India Equity Fund has 75% in large cap, about 17% in mid caps and 7% in small caps. So this is primarily kind of reflecting the underlying market composition. But depending upon more opportunities, we may swing it a little bit. I think in the current environment, we might find more moderate valuations in the mid and small cap space. So we may take the overall exposure to closer to 30% of the portfolio. And then moderately bring down some of the more expensive large cap valuations stocks in the portfolio. So currently it is 75-25, but the bias is towards increasing towards 30.
Okay. What about return expectations? I mean, of course, past performance is no guarantee of future expectations, but still, if our viewers were to have a certain amount of return expectation, a time horizon as well, by the way, that investors should keep if they want to consider investing in the fund, what should that be?
Over a longer period of time, the fund has delivered mid to high double-digit returns because of the underlying companies compounding at that rate. Most of the companies that we continue to remain invested do show promise of double-digit growth in their profits, and we therefore we think that making that kind of a return over a medium to longer term is should be possible, notwithstanding all the volatilities in the market. Having said that, there are some companies which go through some down cycle, downtrend in earnings growth, or go through periods of earnings growth challenges. It can be in healthcare sector, it can be even in IT sector, it can be in telecom. This periodically can put pressure on the overall portfolio earnings growth every now and then. But we think that as long as the broader trend of these companies over the medium to long term remains robust, can deliver better growth than the nominal sales growth or the nominal economic growth that is available, then the portfolios should be reasonably robust. That's kind of return expectations we set for our investors.
Okay, but it's not just important to look at return. One should also look at the risk factor. And like I was saying earlier, that one must look at their own risk appetite. And the risk comment over here indicates moderately high. So tell us a bit about the risk measure. I mean, would you say that the fund is perhaps not appropriate if a particular investor is very, very conservative or does not want to take a lot of risk?
There are multiple ways we look at risk. For example, is the fund adequately diversified across sectors? Is the easiest form of risk. Throughout various phases of markets, the fund, one of the fundamental aim of the fund is to kind of remain diversified, reasonably diversified, not excessively diversified across various sectors. This kind of prevents the fund from getting excessively invested in a sector or a stock and makes it more vulnerable to any particular challenges that can happen or any macro risks that can come in that particular sector. Other than that, we do have certain internal guidelines of how much exposure we can take in individual companies, individual sectors. For example, we generally do not go over 10% over, let's say, an index weight of a sector, and that's one kind of a control. We also have liquidity controls. We ensure that we own a particular percentage of the free float market cap of a company and not beyond that. This is to ensure that the liquidity risk of the portfolio remains under control. So, combination of diversification, sector caps and liquidity caps are the kind of risk measures that we follow primarily.
Mr. Radhakrishnan, a lot of mutual fund investors tell us they are worried about investing right now because of the markets. Could you explain how timing the market is not for SIPs and MF?
The easier way to explain is what happened over the last week or two. We saw a big spike in the market post some government announcements. Within 2 days, we saw close to 7-8% market rally, and NAVs moved up more or less similar percentages. Had the investors have been out of the market during that time, or subsequently, they might have missed the kind of rally which we saw, and that is why we keep emphasizing the fact that staying invested in the market is extremely important. The time in the market is more important than timing the market, because it's virtually impossible to time the top and the bottom unless one is really lucky, and therefore one should always say that I'm not investing for the bottom or for the top. I'm investing for the average and above average kind of outlook. So that's the kind of a mindset investors should have, and SIPs tend to help investors to kind of nail that behavioral bias we all have. Every investor would like to be happy when about exiting at the peak or coming into the bottom, but this is easier said than done, especially for investors who do not have time to track the market. This is not at all easy, and therefore we say that do not try to do that, because more often you tend to do the opposite, and that may not work very well for your long-term investment goals. And to that extent, I think the systematic investment planning or being in the market for longer helps one to nail that behavioral flaw.